Today's video is serving as a primer for Tesla covered calls, the 5 W's: who, what, where, why, how, etc., when as well. I'm going to get right into it. I'm going to share my screen. I'm Bradford Ferguson. I have experience as a stock options market maker, but also as an investor. What we do at Rebellionaire is we help people who have concentrated positions in Tesla stock, typically 2,500 or more shares, and we do this at rebellionaire.com. You can check us out there. So first, let's start off with what is a Tesla covered call. To do that, we want to start off with a call. A call, the payout on a call looks like this, where this is your strike price. And let's say Tesla is around 460 a share right now. So we'll say that strike is 460. The payout on a call is a dollar per share above the strike price upon expiration. That's the value of it. They don't necessarily pay it to you, but you can buy the stock at that price. A call is the right, but not the obligation to buy the shares at that strike price. When you're long the call, you have that right. When you're short the call, you've sold that right to someone else. These options are continually trading during normal market hours. Let's look at the profit and loss of this. This option, maybe it would cost $5 per share. That if it expires at 60 or lower, it has a value of 0. For 60 or less, you lost $5 per share. Now, calls typically trade in a contract size of 100. So it's equivalent of 100 shares. So to buy that call, which gives you exposure to 100 shares and the right, but not the obligation to buy at 460, and gives you that 100 times. So this costs $500. So it's $5 per share times 100 shares. Now, let's say the stock finishes Friday at 500 per share. The value of the option is the share price minus the strike price, which would be 500 minus 460, and this is per share. So it, over 100 shares, that would be $40 times 100. So that would equal $4,000. So this shows the leverage that is in options. It's very easy to lose 100% of your money when you're long an option, but you can also multiply your money as well. So options are very complex, take a long time to learn, but this is just a primer. But let's say you were just long the stock. So in this example, you basically multiplying your money by 8, but you have a $3,500 gain, which is a 7x. Now, if you just have the stock, you don't have the leverage, and your shares went from 460 to 500, and that's a gain of less than 10%. whereas the gain here is a 700% gain. So you're fronting $500 and ending up with 4,000. So that would be an 8x, sorry. So that's the leverage, but the cost of this is, often it doesn't work out. So what a covered call is, it's where you're long the stock. So when you're long the stock, the profit and loss looks like this. You might have 2,500 shares of Tesla. For every dollar that it goes up, your P&L increases by the number of shares. So in this case, it would go up or down by $2,500 for every increase or decrease in share price. Now, what you can do when you're long the stock is you can sell a covered call. So the P&L from the covered call looks like this upon expiration, where this is your strike. And for every dollar above your strike, you're essentially down $1 per share. So that's a short call. Now, why, as a person who's very bullish in Tesla, would you sell a call against your stock? Well, what you can do is you can do it on the upside. So maybe it looks like this, where you collect a little bit of premium, but at a level that's higher than where the stock is. Maybe this is a weekly call and you sell 10% out of the money. So maybe you're selling the 505 strike. Now, that's not necessarily what we do, but that's what you can do. To do that, you collect a premium or a yield on a weekly basis if you're selling weekly calls. Doesn't mean you have to do it every week, but that's what it looks like. The beauty of weekly calls, in my opinion, is that you can shift that strike price higher each week as the share price goes up. So let's go to our next one. Why Tesla cover calls? So the main reason why is you collect a premium. You're selling upside. This is informed by research when we're doing it. How far above the share price do you sell? The riskiest, where you're going to be constantly having to deal with your calls that go against you, would be at the money. So that what that means is where the stock is trading. But you can also do 5% out of money, 10%, 15, 20. The closer you sell to at the money, that's where the highest premium. But it's also the riskiest to being called away. There's a whole industry around being really aggressive with covered calls, where you're doing it either at the money or 5% out of the money. These people have a money tree vibe, like it's free to do, but it's not the case. A good way to lose shares over time, and we've done back tests on this. We have a video and you can find it. Search for TSLY and Rebellion Air on YouTube. We show what happens when you're too aggressive. So that was a bit of a tangent, but the whole reason why you do cover calls is to collect a premium. As the stock appreciates in value, people get more excited about playing Tesla through the options, and those premiums get juicier. It's a way to create a dividend on a stock that doesn't pay one. How do you do it? You need options approval. I don't suggest just starting this and doing it yourself. There's a lot of horror stories of people who have sold a cover call and then don't appropriately handle a losing week. So when you have a winning week, you get premium, you get money. And typically, what people will do who are very heavy in Tesla is they'll buy more Tesla shares. But then on losing weeks, there's several different ways you can handle that, and people don't handle it appropriately. So, in my opinion, so people don't, you need to get options approval through your custodian. So, maybe that's Schwab, Fidelity, Interactive Brokers, E-Trade, other places. And then what you do is there's a way to trade them. So typically the order type that you're doing that is called sell to open. So you're selling a call to open a position, and you can either let it close if that call is out of the money and was a winning week, you can just let it expire worthless. Or what you can do is buy to close them. If you do it before expiration, that's called buy to close. I think cover calls and options need a lot of research. Matt and myself have studied the history of Tesla stock options and looked at what environments covered calls did well, how they did over time at the money versus 5%, 10%, 15, 20% in those regimes, and what you want to do when, and encourage people to really study it if you're going to do it yourself. So let's talk about the expiration choice. I've been talking about what we do, which is weekly. Typically, that's 1 week out, but it can be multiple weeks. Uh, could be 2 to 4. There's monthly. There's also leaps. You can sell leaps against your position. I personally don't like the monthlies or the leaps. What we see a lot is where brokers will choose to do the monthlies because it's less work. It seems a little more innocuous. You can generate a little higher income, but you're greatly increasing that time exposure. The problem is that it puts multiple week runs, and the longer duration on the calls, it's worse when you're short them. And it can cause a bad situation. Whereas with weeklies, each week you get to reset your strike price. After each expiration, you can reset your strike price. So if Tesla's going down to get a similar premium to what you're getting, you'll have to go down in strike price. But when it's going up, you can go up in strike price. Let me just illustrate that real quick. So at 460 a share, a 5% out of the money would be about 482.50. So those cover calls do trade. Let's say next week it starts at 420 a share. The 5% out of the money, if you're following that discipline, would be more like 440 a share. So 441 technically, but 440 would be the closest 5% out of the money strike price. When do you sell them? Some people do them every week. Some people will skip production and delivery weeks, where on the second day of each new quarter, Tesla releases that report. Also, people may and or skip earnings week. They might also skip event weeks like We Robot or Battery Day or Investor Day or product reveals. You could also change how far out of the money you go on those weeks where the volatility can be higher. There was one week that we skipped, which was election week. That was a very good week to skip. We had a good sense that Trump was polling much better than in 2020, and that it was looking extremely favorable for Trump. And we thought that would benefit Tesla share price. So we skipped that week. Now, past performance is no indication of future returns. How much Tesla covered calls? So we talked a little bit about the premium. You can go and look at the type of premium that you could generate in a given week. So you can look at January 3rd, 2025. You can look at January 10, 2025 as the expiration. And you can look at the at the money versus the out of the money levels. So that tells you what kind of premiums that you can generate. But this first week is especially unusual because it's a production and delivery week. So premiums will be elevated for that. The week after that, it's not expected to be special, but anything can change that. A question some people have is how many shares do you do it on? So do you do it on 10%, 50, or like 95%, somewhere in between? That's it's personal preference for you, but for us, it's driven by research. And then where Tesla cover calls, here we'll talk about the different types of accounts. We call the non-retirement accounts, we call those taxable accounts. Some people call them brokerage accounts. We don't call them that here because we're not brokers. You got IRAs, you got Roth IRAs. Some people have a 401k account where they can do cover calls. So that's called a brokerage link, that Fidelity. Now, if you're doing cover calls in a taxable and the cover calls go against you, you have to be careful. If you allow your shares to be sold, if you don't defend against your cover calls being exercised, then you can have capital gains. It's critical what you do in an account where there's a tax consequence for selling your shares. But it's a way to generate income. It's a way to add to your shares over time. Those things don't matter as much in the IRA and the Roth IRAs. In these accounts, you don't have margin. So everything's on a cash basis. And if you have a week that goes against you, it could be a little tricky. You may need to sell some shares or give up some shares in a losing week in order to get out of the covered calls, depending on how you handle that. All right. So I'm Bradford Ferguson with rebellionaire.com, and it's been good talking to you. You can find us there if you want to talk about covered calls, if you're have a heavy exposure to Tesla and 2,500 shares or more. There's other services we provide for rebellionaires, such as trimming and adding rather than just hodling your shares, adding some other high conviction growth companies, and also financial planning, developing a financial master plan. With that, I'm going to say bye for now.